Hey, hi, Jyoti. Can you see me? And can you hear me?
Yeah, Srinath, I can hear you.
Uh, it's audible, right? So,
Yeah, yeah, completely audible.
yeah, okay, cool.
ज्वाइन 5 मिनट्स में चालू करते हैं।
ओके, तो मैंने रिकॉर्डिंग ऑन कर दिया है
ओके ओके,
और आपको मैं यहाँ पे से होस्ट करके मतलब कि ये
एक 2-3 मिनट में चालू कर देते हैं।
प्रेजेंटेशन का ऑप्शन भी दे दिया है।
इसका ऑप्शन दिया आपने?
पीपीटी शेयरिंग कर सकते हैं। पीपीटी आप स्पीकर आप ही हो, कौन हो मैम?
स्पीकर श्रीनाथ है, श्रीनाथ कुमार।
हेलो श्रीनाथ सर, आप पीपीटी एक बार शेयर करेंगे सर?
Yes, sure. Let me know once it is visible.
Yeah, it's visible.
I'll put it on full screen once everyone's there.
Yeah, sure. Let's start the session. In the meantime, if others may join. Shnath, are you there?
Yes, Jyoti,
Yeah.
if you can hear me.
Good morning, one and all, to join on today's call. Today we are going to speak on taxation of charitable trust, and we have speaker with us C.A. Srinath Kumar. To briefly introduce C.A. Srinath, currently Srinath is working as a manager in Global Business Tax Team of Deloitte. He is associated with Deloitte since 2012. He has vast experience in international taxation and corporate taxation. He has written various articles in relation to income tax, which have been published on reputed websites. He has recently authored a chapter on withholding taxes in the CTC publication as well. We welcome Srinath. Srinath, we request you to please start the session. Thank you. Thank you for taking time and giving us a session today.
Thank you. Thank you, Jyoti, for the brief introduction. Good morning, everyone. Let me know if my full screen is visible.
Yeah, it's visible.
Yeah. First of all, good morning, everyone. Myself, C.A. Srinath Kumar. As Jyoti introduced, I am into the field of taxation. And when Jyoti had initially told me to choose a topic, I chose taxation of charitable trusts. The main reason was I had a presentation which I had made last year, which I thought I can improvise in a short span of time and take this topic. But at the time I started preparing for this topic, I realized that too much has happened on the taxation of charitable trusts. Too many amendments and too many circulars have come. So it was a good learning for me also to put this paper into a PPT. I hope we all learn together in this study circle. I think the main objective is to network and to also share our experiences. Income tax being an act, every time we read it, we get new interpretations. And I think out of experience, we all can share our experiences in this session. What I would do is I would touch upon briefly from introduction till we discuss some case laws. I would request every participant to share their relevant experiences by raising their hand at any point of time during the session, so that everyone here learns. I think the key objective is to learn, share, and grow. So with that, I will start my session today. So when I was introduced to the topic of charitable trusts, I had got this example explained to me, so I would like to put it across. So let's assume that there are 10 people who want to do a charitable activity. Let's say they want to do a midday meal program in their locality. So let's say 10 people contribute 100 rupees each, and now the sum collected is 1,000 rupees. And then they buy the material for distribution, and let's say whatever the cost incurred, let's say it's 800 rupees. Now the 200 rupees which is left, ideally if this is set up as a registered body, the 200 rupees would constitute income. And on such income, under the Income Tax Act, either you will have to pay tax on the slab rate or pay tax at a particular rate prescribed to a company, depending on the entity which is set up. So the 200 rupees, which is the excess of income over expenditure, will get taxed. So let's assume it's at 30% rate, so around 60 rupees will be taxed, and that amount will go to government. So the objective of charity, though it is met, the 60 rupees is being taxed. So government realized that such entities who are into charitable activities for the welfare of the society in general, there should be some sort of exemption given, because governments themselves have realized over the years that it is not only the government's responsibility to help the society, it is our joint efforts which we can help the society, uplift it, and help in the nation building. So the government realized that this 200 excess, which is coming from an in excess of income or expenditure, there has to be some mechanism under the act to not tax that 200 rupees. For that, there is section 11, 12, and the other sections we will discuss today, wherein the government has prescribed various rules and provisions whereby this 200 rupees is not taxed and is allowed to be applied to the same charitable purpose for which the trust or the entity was formed. So let's say the same set of friends, 10 friends who want to do this charitable activity, they come across to us as consultants and ask us whether we should set up as a regular trust or whether we should set up this as a Section 8 company. So there are two types of options when it comes to registration and taking exemption in the Income Tax Act. Both the Section 8 company and the trust, both are equally treated under the Income Tax Act. So the benefit of Section 8 is that you get a regularized setup, you have a corporate entity, you have all the filings with the MCA. It's a very structured approach. The disadvantages are that you have regular filings to be done. The cost of compliance is huge. Vis-a-vis, at the same time, if it's a small setup or a regional setup, a trust kind of a structure is usually advisable with lower compliance cost and lower regulations which apply. So we can advise on setting up of Section 8 vis-a-vis a trust, depending upon the facts and circumstances of each case. Now, when we talk about trusts, there are two types of trusts which are broadly discussed under the Income Tax Act. One is for charitable, which we will discuss in this session. And one is a non-charitable trust, which is usually used for, let's say, family type of arrangements where the property has to be distributed between families, or in a company like of structures where REIT, InvIT, those kind of trusts are set up. Our focus and points of discussion for today will be charitable trusts. That also specific to Section 11. We are not discussing 1023C because it has its own nuances. And I think we should dedicate our session to Section 11 and the consequential sections which impact section 11. So during our discussion today, we'll be touching upon broadly these sections which have an impact on taxation of charitable trusts, which is section 2, subsection 15, which describes what is a charitable purpose. Section 6, which says what is the residential status of a trust, where the control and management of the trust is situated. Section 12A, which says what are the conditions for section 11 and 12. Section 11 is the basic section which gives you the exemption for the 200 rupees which we discussed. 12AB lays down the registration process which we'll discuss in detail. 11 again gives us the basic exemption for the income under the trust. And then we have some special sections 115 BBC, 115 TD and 115 BBI for taxation of this anonymous donations, accretion, and on specified income of trusts. So broadly, we'll touch upon these sections in the course of our session today. So let's say the group of 10 people come to us saying that we want to carry out the charitable activities. So income tax realized that we have to define what is charitable purpose so that entities can register under the respective limb of the act. So income tax under section 215, section 2 usually gives the definitions. Under 215 has defined what is charitable purpose. Broadly, they have bucketed into 7 categories, which includes relief to poor, education, yoga, medical relief, preservation of environment, preservation of monuments, advancement of any other general public utility. So a question may arise that what happens if my intention does not fall into any of the 6 buckets. So that's why they have kept a bucket of any other public utility. So if I go back to my example, the basic objective of a trust is that whatever income a trust generates, it has to be applied for the purpose which it was created. But at the same time, let's assume that there is a company. The main objective of a company is to earn profits for its shareholders, to earn a value for the shares for their shareholders. In nowadays generations, though these startups may not have profits, but they do have a good valuation which is attached to the shares. So that is the benefit they give it to their shareholders. But an entity which is created where the income or the corpus is applied only to the specific objects, and any surplus, if it is generated, is again applied to the same objects, that is a charitable trust or the institutions which we'll discuss in the future slides. So a question may arise, what is relief to poor? The charitable purpose, since it defines these 6 buckets and one other bucket for others, what is relief to poor? So relief to poor in a common parlance would mean that we are providing benefit to the people below the poverty line, or people who cannot afford certain basic amenities such as food, clothing, shelter. So I'll just go to a slide wherein I have discussed relief to poor. So relief to poor is seen as any activity which has a public character, which is having a benefit to the public at large and not to only a selected individuals. So if let's say, let's take this example of what does not constitute relief to poor. It says if we are trying to help persons suffering from ill health, let's say we all come together and create a fund and help people who are in hospitals. Such cases are not covered under relief to poor because there might be some people who are able to afford. Even if we start helping them, that is actually not serving the purpose of relief to poor. So only helping people from ill health will not constitute relief to poor. Again, what does not constitute relief to poor? Assisting unemployed and giving them certain assistance, again, will not amount to relief to poor, because of the fact that people who are unemployed may or may not necessarily be poor. Okay. And if any trust or any institution is just created to provide benefit to the poor members of a family, and it is remotely only assisting the society at large, those kind of trust is also not considered as relief to poor under the charitable purpose definition, which is given in the Income Tax Act. The main purpose when we see for relief to poor is that it should benefit the public at large. It should have an inclusive purpose. Whoever is facing difficulty to meet their food, clothing, shelter, basic necessities. So, for example, if you see the Calcutta High Court has held that providing marriage expenses to poor is held as relief to poor. So some might say that, okay, food, clothing, and shelter are the basic. Why are we giving more importance for marriage? Because courts have realized that marriage and matrimony is also a basic necessity of life, for which certain strata of the society face it difficult to collect funds to manage such expenses, feel it burdensome. So providing financial or assistance in kind to such kind of people will also be considered as relief to poor. One of the other examples where the Bangalore ITIT has held that providing loans to poor women so that we can empower them, we can assist them in buying certain assets so that they can start their own business or venture is again considered as a relief to poor. So yeah, there is no end to this discussion of what will constitute relief to poor and what not. But the basic principle remains that it has to have a public character, has to apply to public at large, help people in the marginalized section for their upliftment. So that will constitute relief to poor. If I go back to my definition of Section 215, the second bucket of activities which classify a charitable purpose is education. So now the word education itself is so vast that it will have to be understood at what constitutes education for a charitable purpose. In simple black and white terms, if someone sets up a college, if a group of people or a group of trust sets up a school, it's not necessary that education institution has to be set up in a metro or a non-metro. It can be set up anywhere because it will qualify under education. So those kind of classical examples come under the bucket of education. While discussing this education definition, there is a Supreme Court decision in case of Lok Shikshana Trust, which was given in way back in 1976. While discussing that ruling, the Supreme Court observed that education is a vast subject. So sometimes we get vast experience while we travel, where we go on road trip, when we go to trips on nature, we get a lot of information and gather knowledge. Whether that will amount to education, the Supreme Court said no. Some people might argue that I read newspapers every day, so the newspaper publications have to be educational institutions. They are imparting knowledge. The answer again is no. So sometimes learning comes through experience by exploring things. Whether that kind of activities can be classified as education, the Supreme Court said no. The Supreme Court interpreted in this case that systematic instruction or school training is generally classified under the education, and the process of developing the knowledge, skill, mind, and character of students by formal schooling is something what the department has envisaged under the bucket of education. But in my practical experience, what I have seen is that I have seen an institution who gives knowledge, imparts knowledge to, let's say, official organizations, to the government sector companies, to various participants on how to lead life, on honesty is the best policy, on the importance of hygiene. And that trust with their specific objects have got their registration under this bucket of education. So though the income tax, though the case laws have laid down certain guidelines, the department has now seen that after 1976, there has been a revolution of the term knowledge and formal schooling, and that the education has gone way beyond the four walls of schools, and it can be imparted in various means. So department is analyzing the specific objects, what impact it will have on the society, and deciding whether it will qualify under the bucket of education or not. these are the first two limbs. Third limb is yoga. India being the birthplace of yoga, the department realized that yoga, any activity or any group which is constituted mainly to focus on yoga, any income of such institution should be exempted under Section 11 based on that they spend their income towards the furtherance of yoga. So yoga is specifically covered. Then we have medical relief. So again, medical relief is providing assistance in form of a hospital, in form of a small clinic, which is set up just to provide medical relief to people who come, who cannot afford. Such kind of medical relief institutions are also allowed exemption under Section 11 by registering themselves with the income tax. Next two buckets are preservation of environment and preservation of monument, which the term itself explains what the such institutions will do. If none of these specific buckets are, we are able to classify our trust into none of these specific buckets, then we have the bucket of GPU, which is general public utility. So any of the activity which we do, which will not classify here, will come under the GPU category. Now, the only interesting observation in GPU category is that for GPU category, you should not have income in the form of trade, commerce, or business where you collect certain cess or fee, which will constitute more than 20% of your total receipts of the charitable institution. So for example, if my total income of a trust is rupees 100, which is in the GPU category like others category, that 100 donations, out of that 100 donations, only 20 or within 20 should be such income which is coming out of this trade commerce activities which this general public utility is undertaking. This 20% restriction is not applicable to the other 6 buckets because they are doing their respective activities in their respective fields which is identified by the department. This 20% restriction applies only to the GPU category. So the income tax has realized that whoever comes to me, I will classify them into these 6 buckets. If not, I'll classify them to 7 and give them appropriate registration. So proceeding further, Jyoti, am I audible and is the PPT visible? Yes, fine. I just checked because it's a virtual thing. Sure. So let's discuss about registration. So income tax for allowing the benefit of Section 11, we have to undergo a registration process. Usually for companies, there is no specific registration. Only by obtaining PAN, you are registered with the income tax. But for these kind of specific entities where the income tax is forgiving or foregoing the revenue on the of taxation on the excess income, they have a specific set of registration mechanism. In earlier years, what used to happen is that this registration, which was granted for perpetuity. Means, let's say the trust was registered in 1970, it has been granted exemption for perpetuity. Then the government realized that this perpetual exemption which is given to trusts at certain cases are leading to misuse. And they realized that they have to scrutinize the objects of the trust and what are the exact activities the trust is doing on a timely interval. So then in Finance Bill 2020, they realized this and then they tweaked the registration condition saying that the trusts have now to register every 5 years. The registration which will now be given or the existing trusts which have already been registered will be given a new registration with a specific identification number, and such registration will only be valid for a period of 5 years. 5-year period is given so that the department also can check the compliances, and at the same time, the assessees are also not required to go every year to the department for such registration. Okay, so how is the registration process mandated under the Act? So the registration process under Section 12AB, it is given under Section 12AB into various buckets because we are dealing with trusts which are already registered since 1970. There might be certain trusts which are wanting to register right now afresh, and there might be trust in future where the 5-year period has been expired. So the department has appropriately made 6 buckets saying which trust has to register where and how and when they have to register. For registration, you have to file the form 10A or 10AB. So the trusts which already had existing registration, they had to register on or before 30th September with the Income Tax Authority in form 10A. And once the application is made, it will be scrutinized, and the order which will be given for registration will be valid for a period of 5 years, and such order has to be passed within a period of 3 months. So this was for the existing registration trust. Now we'll talk about new trusts. Let's say the example which I initially discussed, that 10 people wanted to do something in their local region. When they form a trust and start a new registration, they have to first understand whether they have commenced their activity or they have not commenced their activity. If they have commenced their activity, they will go for a regular registration. If they have not commenced their activity, they will go for a provisional registration. Once their activities are commenced, they will then go for the regular registration. This amendment we will discuss in the later slides. So earlier, the amendment was that new trusts have to strictly go for a provisional registration. But then the government realized that new trusts which have already begun their activities will have to go to 2 types of registration. One is the provisional and one is the new registration. So to avoid that, the government is now clearly saying that if your activities have begun, go for the regular registration. If activities are not begun, take a provisional registration. And once your activities are going to begin, take a registration before that, before 6 months before commencement of your activities. So for the new trusts we have discussed, certain trusts wherein sometimes what happens is this section 1023C and section 11 are so interlapped that some trusts register under 1023C as well as section 11. So the government realized this and have plugged the loophole, and it's now very clear that a trust can either take 1023C benefits or be under section 11. So in case is there any swap between these 2 registrations, such kind of registration is also covered, wherein 5 years approval is given by the department. And then if you have a certain set of objects, let's say we will do poor feeding, we will undertake distribution of clothes to needy. These are all your objects of the trust. When you register, you have to give your objects of the trust, your bank account details, your trustee details, these all details to the department. Subsequently, if there is any change in the objects of the trust or in any conduct or any documents which are already given to the department, then you have to apply for a re-registration 30 days from adoption of such modification. Because the department has given you the registration based on certain assumptions and certain documentation. If there is any change in such documentation, you have to re-register. And in any other case, it is 1 month prior to commencement of the previous year, you have to apply for registration. This registration is granted for a period of 5 years, and before that 5-year period expires, 6 months before, you have to again apply to the department. So now this registration process is clear. It is a single form for 80G, which we'll discuss in the later slides. Single form application. Every 5 years, you have to get your trust re-registered. We have to ensure that our clients don't miss this deadline. We can send calendar invites to ourselves and the client on expiry or before 6 to 8 months of the 5 years, because we may tend to forget this critical deadline, which will have an impact of MMR taxation on the net assets of the trust, which we will again discuss in the subsequent slides. So I'll just check the chat box. There was one question. Whether educational hostel is come under the object of education. I think this is a brilliant question. We have our, I think, educational hostels for ICA in the Western region. I'm not recollecting the name. Ideally, educational hostel should, we'll have to discuss what is the exact objects of that hostel, whether they are imparting any education or is there only a residential place giving food and meals to the children. If that is the objective, then it may fall under the GPU, general purpose utility. If not, if they are imparting any education, then it may classify under the educational bucket. This will have to be seen on the specific, what are the objects of the trust. So with that, I don't see any other questions in the chat. I'll proceed to the next part. Yes. So section 12AB registration is for the trust register itself under the Income Tax Act. So what happens is, when the trust is created, we require donations, we require funds for the trust to function. So what is the benefit which is given to the subsequent counterparty? That is the tax deduction they get, about 50% of the amount they contribute from their GTI. For that, the trust has to be registered under section 80G. So usually the donation to government organizations, relief funds, Chief Minister relief funds are all covered under the 100% exemption. And all the other donations given to these local trusts which are registered with the income tax under 12AB and 80G, the benefit is available is of 50%. So earlier there were two separate forms for registration under 12AB and 80G. Now there is a single form 10AB for which we have to apply to the department. Single form for registration of the trust as well as the 80G registration. The 80G registration is required so that we give this benefit to the donees, so that the donees can quote the PAN and the acknowledgement number. I will discuss the return requirement in their returns and claim the benefit of 80G. So there are certain conditions earlier which was prescribed, currently also continuing, that the entity which is applying for 80G should be claiming exemption under section 11. Such institutions should not be for the benefit of a particular religious community, and the institute has to maintain a register of accounts of receipts and expenditure. If certain these conditions are satisfied, the PCIT of jurisdictional PCIT will grant the exemption to the trust, that this trust is registered under 80G. So any donations given to such trust will be eligible for 80G deductions. The question may arise that, let's say I have made a donation of 1 lakh rupees to ABC Trust, and let's say that trust, due to modification of objects or certain violation under the Act, has violated some conditions and the registration is revoked. So whether I will be eligible for that 1 lakh deduction or I am also penalized. So the Act says the donor is not impacted, only the trust is impacted. The donor will still get the deduction for the amount which he has donated in that particular year. Next question may arise that whether the donation which I am making to the trust has to be in cash or it can be in kind. Whether I can donate in kind. Let's say I give my Apple phone to the trust and say that you can utilize for your general administration. Whether that will be counted for my 80G benefit? Answer is no, because again a Supreme Court rulings have come which says that this deduction under 80G shall be allowed only if there is a sum of money which is given to the trust. Donation in kind shall not be eligible for 80G. So that is the decision which has been given. And 80G now has been, this trust setup has now been very famous in the industry for CSR setup. What is happening is, under the Companies Act, if you qualify certain profit limits and turnover limits, you are required to mandatorily contribute a fund, constitute a CSR fund and do these activities. Such CSR entities are also registered under 80G and 12A, so that they claim this exemption under the Act and also give benefit of section 80G to their respective donees. So now this trust registration and trust topics have picked up speed in the market. So we all CS have to ensure that we are at least having a fair bit of idea of these provisions, so that we can discuss this with our potential clients or with the management or other stakeholders. I just saw one more question on the chat box, if I may take that. It says providing of lodging and boarding facility for poor students who do not afford college hostel facility. Yes. So if this is the fact of the case, I think it is better to argue under relief to poor rather than in education, because here we can say that we are providing relief to public at large and also helping the marginalized section of the economy. So I think relief to poor would be an easy argument in this case. But again, we'll have to see how the object clause is drafted and how the department again looks at this, which is a very factual fact-finding activity which the department does. So moving on. Again, like the 12A registration, the ATG is also again granted for a period of 5 years. As similar to 12AB registrations, the existing trusts had also to re-register themselves before this cutoff date of 30th September 23, and such registration is valid for a period of 5 years. New trusts again have to be registered, and again they'll be given for a period of 5 years. Any other cases which do not fall under these categories, registration is given for a period of 3 years. Now, earlier what used to happen is that randomly people used to give donation to these trusts and make these ATG claims, false ATG claims in their income tax returns. So the government realized that there is a, while the activities of certain trusts are genuine, certain minor, trusts are indulging to these activities wherein cash donations are given or donation kinds are given, and the cash is returned back to the person and the person is claiming ATG. Just to keep a track and strict monitoring of these donations which are given to the trust, the department introduced a new compliance that the trust by end of May have to file a form 10BD wherein they give the list of donations received along with the name and PAN of the person who has given such donations. So once this trust provides the details, let's say trust says that Mr. ABC has given 1 lakh rupees. That trust will have to give this PAN amount and name of the person in this form 10BD, which has to file by 31st May. And once this file is uploaded, the department issues a certificate under 10BE, which has to be issued to the respective donees, so that the donees get these donors get the certificate, and then they use the certificate information in their returns so that everything is tracked. With this AIS and TIS statements which have come, we have to keep the department on top. They have too much information about us. Knowingly or unknowingly, when we are speaking to clients, they don't disclose their investments, they don't disclose their donations, they don't disclose their mutual funds. All this information is now captured in this AIS and TIS and whatnot. With the era of AI and machine learning, the department has heavily invested in this. So considering that, we have to be careful, and while advising clients, we have to tell that if you are claiming ATG, please insist the trust for which you have given donations to give you the 10BE certificate, and based on that only we should lodge a claim in the income tax rate to avoid any further scrutiny. Right? I'll take a pause if there are any questions, or should we proceed? So silence is taken as proceed. So I'll proceed. When we are discussing trust, it's important to discuss what kind of incomes and expenses come to a trust and how the income tax discusses it. The incomes could be in a form of a corpus donation or a non-corpus donation, and how this corpus and non-corpus has to be applied towards the objects of the trust, we will discuss in the subsequent slides. And the trust at the same time can hold a property based on which it generates income. For example, a school building is a property held under a trust from which it generates income in the form of school fees or any other income, which we will discuss detail in the subsequent slides. So, there is a concept of corpus donation under the Income Tax Act. Corpus donation means a donation which is given with a specific direction. For example, let's say institution ABC gives donation of 10 crores to institution PQR, saying that you develop a medical hospital for the poor. So this donation has come with a caveat that this amount has to be used for that particular purpose with that particular guidelines. So that will form a part of your corpus. So whatever expenses you're doing out of your corpus will not be allowed as a deduction or an application towards a general income, it will be accounted from your corpus itself. When we discuss the examples, I think it will be better understood. So this kind of donations which come with a specific rider that it has to be used for this purpose will go under the bucket of corpus donations. The general donations which are received by a trust or institution will come under the bucket of non-corpus donations. So these are the type of donations. What are the other types of income which a trust can get? The trust can get income from its own activities. Let's say a medical institution will get income from its patients. An educational institution will get income from the students. Such kind of income are the income from the activities of the trust. Income from the property held in the trust. Let's say the trust holds a vacant land, which let's say it gives on rent, and that rent is let's say less than 20% of the total income if the trust is under the GPO category. So that kind of income also a trust can get. And then the trust can get donations without any specific directions. Okay. To better understand that, let's take an example. We are discussing case study 1. So in case study 1, what we have plotted is, let's say that trust receives voluntary contribution for corpus of, let's say, 50 lakhs. Voluntary contributions with name and address, 70 lakhs. And out of that, the 70 lakhs, they have applied 50 lakhs. And third category of income is income from property used for charitable trust. Let's say out of the building, they have received 22 lakhs and they have applied 12 lakhs. Usually for a company, if I have to start my computation of income, I start from the net profit, add certain disallowances which are prescribed under the Act, reduce certain allowances, arrive at the net profit and tax it at 25 or 30%. But for a trust, what we have to do when we start any computation is we have to list down the incomes, list down the expenses, and then arrive at an income to understand whether that has to be applied or whether it has to be accumulated. For a trust, a basic 15% exemption is outrightly granted, meaning if you receive rupees 100, you have to only show application or prove to the department that 85% of that 100 rupees has been applied to the objects of the trust. So now in this example, 70 lakhs has been a voluntary contribution received with name and address. So that 70 lakhs we start as a starting point. Add the income from the property used for charitable trusts of 22 lakhs. Come to a total income of 92 lakhs. Now question may arise why we have not taken the corpus donation of 50 lakhs. It's because it is exempt under section 11(1)(d). It says that whatever you receive from corpus donations and whatever you spend should be kept outside the computation. So currently we have not taken that. So out of this 92 lakhs, as I mentioned, 15% is assumed application. So that 15% allowance we'll get. Then we come to a balance of 78 lakhs. So now we see out of 78 lakhs, how much income this trust has actually spent towards the objects. It is this 50 lakhs plus this 12 lakhs, which will come to 62 lakhs. So the trust has spent 62 lakhs out of the balance 78 lakhs of income. So the trust has a surplus with it of 16,20,000. Now, in an idealistic situation, we had to apply the tax rate to the 16,20,000. But considering that this trust is registered under section 11, the trust has option of accumulating this income to future years. They can say by filling a form, which we'll discuss in the subsequent slides, that this 16,20,000, I will spend it in the next year. With that, the department allows it and the income of the trust is considered zero for this year and there is no tax liability on the trust. If I go back to my previous slides to discuss what types of income a trust can receive, we have discussed voluntary contributions which come with a specific rider or which do not come with a specific rider, how they are taxed. Certain times what happens is these kind of trusts also receive anonymous donation. It may happen that the donor does not want to disclose its identity, donor does not want to disclose his PAN or such kind of category. And let's say the trust bank details are available and the donor, let's say, transfers ₹1 lakh, or donor puts a bearer check, or donor just keeps a cash donation of some amount to that trust. Such kind of donations are categorized under this bucket of anonymous donation, wherein The separate tax treatment will be discussed in the subsequent slides. So this anonymous donation is not counted under the computation under the normal mechanism. We discussed the income from property held under the trust. Then there is a concept of capital gains income for a trust. Usually what happens is when we do a capital gain transaction, the normal sale consideration less the cost of acquisition of the asset, less any expenses incurred, and whatever is the balance figure is the capital gains. So for a trust, what they say that if the net consideration, your sale consideration minus the cost of asset, if the net consideration is entirely applied towards net consideration is utilized fully for acquiring another asset, then the entire capital gain is assumed to be applied to the objects of the trust. In case you are not applying the net consideration which you have received is only used partially for acquiring another capital asset, then you have to compare the actual cost of the original asset and the cost of the asset which you have purchased. Whatever is the difference, that amount will be treated as application of income that we will discuss with an example. So I'm at slide 18. Let's assume that the trust had a cost of asset of 40,000. It received a sale consideration of 1,20,000 when it sold that asset. Expenses in relation to transfer was 20,000. And we'll discuss three scenarios wherein the new asset is purchased for 1 lakh, a new asset is purchased for 80,000, and a new asset is purchased for 45,000. So in the first case, after deducting the expenses on transfer, the net consideration is 1 lakh. The cost of new asset purchased, the cost of asset purchased was 40,000, and the idealistic capital gains is 60,000. However, in case one, since I have purchased a new asset of 1 lakh, the capital gains which is deemed to applied is 60,000. The entire capital gains will be deemed to applied, and hence there is no shortfall or any taxable amount which is there in this capital gain transaction. In situation 2, similar case wherein I have a net consideration of 1 lakh after the expense, and I have the cost of asset 40,000, and I have a capital gain of 60,000. Here the investment in the new asset is of 80,000 rupees. So the net consideration is 1 lakh, and I have applied only 80,000 rupees. Accordingly, I'll fall in the second category where I have to compare the original cost of asset, which is 40,000, with the new investment made, which is 80,000. So the excess is 40,000. That 40,000 will be understood as if it is applied towards the object of the trust out of the capital gains of 60,000, and balance of 20,000 will be treated as a taxable receipt under this capital gain working. If I move to an example with similar figures, the net consideration is 1 lakh, capital gains is 60,000. The investment in new asset is only of 45,000. Now, if I compare with my net consideration which I received, it's far less. Now, if I compare with my cost of acquisition of the asset, it is greater than by 5,000. So 5,000 will be treated as capital gains which are applied. Assume it's a deduction given. 55,000 out of the balance 60,000 will be treated as if it's a taxable income of the trust from this capital gain transaction. I'll take a pause here. If anyone has questions, free to answer it now. I think there's a question in the chat box. So at what rate? Yes, the rate of tax I will come to. It's usually with the slab rate or the MMR which is applied. But this 55,000 or 20,000 can be accumulated, which we'll discuss. The main purpose of applying for registration is accumulation of income. So ideally, these trusts do not pay tax on these capital gains. How? That I will explain in the subsequent slides. Yeah. So proceeding further, I discussed the concept of anonymous donations, wherein the identity of the person giving the donation is not seen. So in such cases, what happens is that such anonymous donations are taxed directly at the rate of 30% without any benefit of application or reduction for expenses. So if any trust receives any anonymous donations, the tax rate applied is 30%. But some deduction is allowed. the deduction allowed is 5% of the total donation or 1 lakh, whichever is higher. So that also we will discuss and better understand with an example. Assume that we have contributions without name and address. In the first category, that is an anonymous donation of 6 lakhs. Or contribution for purpose, that is the capital donation, which is of 50 lakhs. Voluntary contribution with name and address, which means we know the identity, which is 70 lakhs, out of which we have applied 50 lakhs for the objects of the trust. Income from property used for charitable purpose, means income coming out of the property, let's say it's 22 lakhs, and let's say we have applied 12 lakhs. So, as I already mentioned, the income coming from corpus, which is of this 50 lakhs, will not form part of my computation. It will stand in my balance sheet. All these other three incomes of 70 lakhs, 22 lakhs, and 6 lakhs, which is coming out of my anonymous property of the trust and voluntary donation, will form part of my starting point of the computation. I have come to an income of 98 lakhs if I add the. Then I have to tax anonymous donation separately. So for that, I need to understand what amount of anonymous donation is going to be taxed. So if you come to the notes in the last 3 lines, anonymous donation received is 6 lakhs. So the exemption which is given for anonymous donation is 5% of the total donation or 1 lakh, whichever is higher. Considering that my donations received is 70 lakh plus 6 lakhs. So 5% of that comes to 3 lakh 80, which is greater than 1 lakh. So that amount is not considered as income. So this 2 lakh 20 will be considered as a taxable receipt. So that I have to reduce from my income, which is going to be exempt. And this on this 2 lakh 20, I'll have to anyways pay tax at 30%. Balance income, I have 95 lakh 80,000, out of which 15% is a deemed application by the department. So I'm left out with 62 lakhs. And out of this 62 lakhs is the amount of expense which I have incurred towards objects of the trust. I'll take a deduction for that. After that, I'm left with an income of 19 lakhs. So this 19 lakhs, I can apply it in the subsequent years, for which procedure we will understand in the subsequent slides. If this was a normal entity, this 19 lakhs would have been subject to tax at the rate of 30%. So we have discussed what types of incomes are exempt and what types of incomes are not considered for taxation of a trust. However, there are certain restrictions which are provided that these kind of incomes will not be eligible for exemptions. Let's say this section is section 13, which discusses these type of incomes. First, it says income from a private religion trust is not eligible, which is not used for public benefits, shall not be eligible for the section 11 benefit. Income of charitable trust created for the particular religious community, again, it's not eligible for section 11 benefit. These 3 types of income, for example, income is applied for the benefit of the trustee. Let's say the trust building, trust has a building which has two residential flats which is available for occupancy. It is occupied by the trustee without any fair rent which is given to the trust. Or let's say the trust manager is given an exorbitant salary. So those kind of applications will not be considered as a deduction or application towards the objects of the trust. So to have that, they have mentioned that every transaction with the trustee or people should happen at a fair market value and at arm's length, so that these trust provisions are not misused. Then they say that whatever the trust has the incomes, it has to be kept in a safe, prescribed modes of investment, which we'll discuss, like bank FDs or savings banks in post office. If it is kept in any other mode other than what is prescribed by the Act, that funds also will be considered for taxation. So proceeding, so we discussed what are the types of incomes. Now we'll discuss what are the types of expenses which will be considered for application of the trust. So in a normal company scenario, what used to happen is we used to take deduction only for the revenue expenses. Capital items we used to take depreciation. But when we are computing a trust computation, we can take deduction for both the capital as well as revenue expenses which are incurred for the objects of the trust. The only condition is that such expenses have to be incurred within the territories of India. If such condition is satisfied, then you can take the deduction for capital as well as revenue expenses. And The thing which they prescribe is that the provisions of 40A 3DS compliances and these cash transactions have all which are prescribed under section 40A3 and 40A3A will also applicable. If you do a transaction in cash more than 20,000, that will not be considered as an application of income. So the next question which arises is, let's say the trust has a total income of 10 lakhs. Whether I have to compute that 15% deemed application on the gross income of 10 lakhs or after reducing the expenses of, let's say, 8.6 lakhs in my example, which is put up on the slide. Is anyone trying to speak? Okay, I'll continue. If out of the 10 lakhs, whether we have to compute the 15% on the 10 lakhs or whether we have to compute the 15% on the net income of 1 lakh 40 after reducing the expenses of 8.6 lakhs. So this discussion was always a position used to be taken by various trusts on the gross income or vis-a-vis the net income. But now the courts have very clearly held that this deduction of 15% has to be computed on the gross income, because section 11A, which talks about this 15% exemption, says that income of a trust derived from the property held of the trust has to be applied for the objects of the trust in excess of 15% of such income. So that 15% has to be calculated on the gross income and not on the net income. So as we discussed in the earlier slides, whatever is the net profit or the excess of income or expenditure of a trust, the Income Tax Act provides two mechanisms to accumulate it. Is that this income, which is excess in the earlier examples, which had to be taxed, you have two options. Option number one, you accumulate it for 1 year. And you say you don't give any reasons. You say it's for other reason. I didn't spend that income for this year, so I'll spend it in the next year. So then you can file this form 9A with the department, and next year you have to apply that balance income, which is not been able to apply this year, under the regular explanation, which is available under section 11. 1 year you will get that benefit. But if you foresee that no, this income which I have, which is over my expenses, I will not be able to apply in 1 year, but the expense will apply in a span of years, then you have to apply under section 11(2), which gives you 5 years period under which you can spend that amount of income. For that, you have to furnish form 10 with the department and mention the specific reason for which that surplus will be utilized. So, and there are also situations wherein the trust has actually not received it, but accounted that income on accrual basis. In that case, also this 1 year exemption and subsequent year exemption can be claimed to say that when such income will be received, I will apply to the objects of the trust, or in the subsequent year, when I receive that income, I will apply to the objects of the trust. So, in a nutshell, what's happening is whatever income you receive in the year, you apply that towards the object of the trust. Whatever is pending, let's say 100 rupees you have received, 85 you have to spend because 15 is deemed application. Out of that 85, if you're only able to spend 60, the balance 25, you have an option to accumulate for 1 year or accumulate it for 5 years. The question may arise after accumulation, if there is any subsequent violation, how does the Income Tax Act treat it? So let's say if you have accumulated under section 11(2) for a period of 5 years, and then you say that you will use this amount for building a school building. And let's say you don't use it for school building, but you use it for, let's say, repair of subsequent other building, then income is applied for a purpose other than charitable purpose, then that amount is taxed in such year of application. This provision is given in section 11(3). When you are accumulating the income which is excess, it has to be kept in a form of bank deposit or in mutual funds or in certain prescribed form of investment. If it is not kept in such prescribed form of investment, the year in which you have removed that amount from that particular investment, it will be considered as a taxable amount. If this amount is not able to be used even after that 5 years, in the 5th year, such accumulation will be taxed because you are not able to apply. At least you pay tax and then you utilize this amount in the subsequent years. certain cases may arise that there is a parent trust and there are subsequent child trust, means main trust and subsequent other trusts which are registered. So the parent trust usually gives donation to this child trust. In such cases, donation can be made only in the current year income. If you make out of this accumulation, then this amount is treated as taxable in the year on which the amount is donated. And even in case if you are not able to apply even after these 5 years, or within these 5 years there is some restriction which makes you do these violations, you can apply with an application to the AO to mention that this amount cannot be used for these objects. And because of this reason, we are facing difficulty. The AO, after considering it, may allow it to be used for any other purpose or allow it to be invested in any other modes. So in such cases, you have to make an application to the income tax officer. I'll take a pause here. If anyone has questions on any of the slides, we can discuss at this point. Okay, in absence of any comments, let's proceed. As mentioned in the earlier slides, whatever income of a trust, it has to be kept in a specific mode. If not, there will be certain violations and then you will not get this benefit of section 11. 1 minute, there's a chat on that. So there is a question that in ITR 7, portal calculates income at the rate of 30% instead of normal rate. What to do? Yes, that is an issue which is ongoing. After the section 115 BBI, which we'll discuss in the subsequent slides, whatever incomes are accruing to a trust due to violations of certain limits, they are directly taxed at 30 because of 115 BBI. But ideally, a trust has to be taxed on a slab rates. But for whatever worth, these portals are calculating a tax at MMR with 30% being the base tax rate. We can discuss this offline, Hemant sir, and take this forward. Yes. So whatever incomes or whatever surpluses or whatever funds of a trust which are lying on the balance sheet have to be specifically kept in these modes of investments, because these are considered the safe modes of investment. It should not happen that whatever, let's say the trust has income, let's say they apply it in the stock market and they lose the money for which it is given. It will not serve the purpose. So for that, government has mentioned strict modes of investments, majorly those kind of investments which are safe and sound, which will give you back the money with a specific increase, such as interest or gains. Such modes are prescribed under section 11(5), which include government saving certificate, post office saving certificate, any deposits or saving accounts with banks, units of the unit trust, debentures where the principal and interest are fully and unconditionally guaranteed by the governments. So there are various modes of investments which are prescribed under section 11(5). Only under these prescribed modes we can keep the funds of the trust. If there is any violation, that income will be taxed at the rate of 30%. So with this computation mechanism on things, now we come to the what are the annual compliances? What are the compliances which the trust has to do on an annual basis? As everyone is aware, a trust has to file its income tax return under section 139(4)(a) within the time which is allowed. The timing for filing is 31st October. Considering that trust has to be audited, and if an entity has to be audited, the due date is 31st October. So the return of income has to be filed on time to claim the section 11 benefit. As mentioned earlier, if there is any accumulation of income, then Form 9A has to be filed if the accumulation is for 1 year. Form 10 has to be filed if the accumulation is for a period of 5 years. The audit of the trust has to happen in Form 10B and 10BB. I'll discuss this in the subsequent slide. And if there is any other audit, like the charity commissioner requires a special report, or an audit has to be given to the charity board, or audit is required under Companies Act, such kind of audit has to be complied. The trust is also not exempted from making TDS. So trust has to comply with the TDS, regular quarterly withholding, monthly TDS deposits, So those kind of compliances the trust has to undertake, and also file the annual ATG return, which I discussed, which enables the donors to take the benefit of the section ATG. Yeah. So now the question is whether there is extension in Form 9A or 10 for 23-24. Ideally, the answer is no, because the date for filing 9A and 10 was 31st August. The idea of keeping it 2 months prior to the date of return of income was that the income accumulated has to be reported in Form 10B, which is an audit report. So for that, you have to already understand what the amount is being accumulated. So for that, they have prescribed 2 months period. But in Circular 6, which has come, I have read that the trust can still file it till the filing of return of income, but that may be challenged by the department and which will have to justify. In case there is any delays, the advice would be to file it as soon as possible with a letter to the respective JAO stating the genuine issues or the reasons, so that at least we have a good case to argue at the time of assessment. As I discussed earlier, there was only one form, Form 10B. 10B was a audit certificate which has to be given on the various incomes and how the trust has made the application. The department has now just bifurcated this Form 10 into two forms, Form 10 and Form 10B. Form 10B is the residuary form, which in case Form 10B is not applicable, you have to fill Form 10BB. Form 10B is in cases where the trust has income which is exceeding 5 crores, or has received foreign contributions, or has applied any income which is for the purposes outside the territory of India. In that case, you have to fill Form 10B. In all the other cases, Form 10BB is required to be filled by a chartered accountant on the income tax portal. So the earlier slides, we have discussed all the main provisions which are applicable to the trust. In the subsequent slides, we'll discuss what are the other provisions or the other nuances which are applicable to the trust. So, as I mentioned, what we have usually observed is that trusts make inter-trust donations to say that, let's say, if I am not able to achieve the object, a similar trust with the same line of objects is undertaking some activity for which it needs funds. So let me donate my funds to that trust. So considering that, inter-trust donations is a widely discussed concept in the charitable trust institutions. So what happens is, if you receive let's say a huge donation of 10 crores for this year, you may understand that you will not be able to spend that 10 crores within a span of 5 years or within a span of next year. Then you have an option to give that amount to another trust. So inter-trust donations are allowed as a deduction only if it is pertaining to that particular year. The year in which you receive the donation, you can give it to an other trust with same line of objects registered under 12AB. There is no adverse impact. The amount which will be computed as application in your computation of income will only be restricted to 85% of such donation. For example, let's say I receive 1 crore donation from a particular donor. And if I donate this 1 crore, in my computation, only 85 lakhs will be considered as an application of income. The logic which the department found out was that in a vanilla situation, if I had received only 1 crore and I had not applied anything, my accumulation would have been only 85 lakhs because 15 lakhs is a deemed application in my own computation. So what these trusts were doing with these intercorporate donations, A used to give to B, B used to give to C, C used to give to D, and finally D used to give that money back to A. With this, all the 4 trusts claimed this exemption of 15% without actually applying it. So there was a misuse. So considering to tweak this misuse, the department has mentioned that whatever intercorporate donations you're making, amount which will be considered as application of trust will restrict it to 85%. So if you donate 1 lakh, it will be treated as 85 lakh as application. If you donate 1 crore, it will be 85 lakhs as application. And in case if you have accumulated some amount and you wish to donate that amount to a trust after an earlier year accumulation, that amount will be treated as income in the year which you donate, because that amount is, you have to spend it to the objects or you have to pay tax on that amount. So that the income tax is very clear on that. Any questions? Yes, I see one question. On the receiver, what happens is receiver trust, in my example, if I go back to my example, if trust A gives trust B 1 crore rupees, trust A will only get 85 lakhs as an application. But trust B will have to take 1 crore in its voluntary contributions and then apply that 1 crore towards the objects of the trust. So trust B, the receiver trust, will have to take the gross amount because it is actually receiving cash of 1 crore. That's why. Yes, I don't see any other questions in the chat box. Yes, so we proceed to the special provisions of section 115 TD. This is a provision which was much awaited because there was no clarity on what will happen if there is a merger, if there is a conversion of a trust into a taxable trust, or if there is any dissolution of the trust, what will happen? And there was no clarity given for these kind of transactions of a trust. Finally, the Income Tax Act has given us specific provision, section 115 TD, which deals with these three situations, where number one, there is a trust conversion from a non-taxable trust to a taxable trust, where there is a merger of two trusts with similar objects, or merger of a trust non-taxable trust into a taxable trust or not registered trust, or there is any dissolution of a trust because if there is any failure to comply with the sections, or there is a dissolution, genuine dissolution, what will happen to the assets and liabilities lying in the balance sheet of the trust? So section 115 TD says, whatever is the FMV of assets over the liabilities, which is, I think, is a fair way of calculating the net income. Whatever is the asset side, take the fair market value, reduce whatever liabilities you have to pay. The balance amount will be treated as accreted income, which has to be taxed at the rate of MMR. That is what the section 115 TD says. 115 TD3 says that there is a deemed cancellation or a deemed conversion. When the registration under 12 is cancelled, that time this section will trigger. When there is an object clause modification without intimation to the government, or where the department has not agreed to the modification, that time this section will be triggered. And within 14 days of this event, we will have to compute this tax, and the trustee is the person responsible who has to discharge this tax out of the trust funds. And then this amount of tax is considered as a final tax, and there is no credit allowed to any other income. And if there is any delay, the 1% interest standard which the department levies per month shall be levied. Proceeding further. So there may be cases where, let's say, the trust has to construct a building or undertake any capital activity for which it is applied bank loans. So earlier what used to happen is when the loan is taken, let's say 1 lakh rupee, a loan is taken from a bank ABC for building a small chamber. The 1 lakh rupee, when it is taken from the bank and 1 lakh rupee spent by the trust, that 1 lakh rupee was also claimed as an as an application. At the same time, let's say after 3 years, when I am repaying the loan, that 1 lakh was also taken as an application. So the trusts were claiming 2 times exemption for the same amount. So to tweak this, the budget 22 or 21 has amended to say that any application from a loan or a borrowing shall be only considered as application when the repayment of the loan is made, and not when expenses are incurred out of the loan. Similar issue was there when the capital expenses were made by a trust, wherein at the time of incurring the capital expenditure, the exemption was claimed. At the same time, depreciation was also claimed on a year-on-year basis. To tweak this double deduction, the department has now clarified that depreciation cannot be claimed in case where the cost of acquisition has been claimed by the asset as application of income. There are also case laws, multiple case laws on the issue of carry forward of loss. These all discussion which we did in the earlier slides was if there is a surplus, if there is an income over the expense, what will happen in a reverse scenario where there is excess of expense over income, there is a loss. Can that loss be carried forward to next year and set off against income? The answer earlier with the courts had given was yes, because in year one, if you have spent more, you should be allowed to reduce that amount in year two. But the Finance Act has specifically amended Section 11 to say that excess application of income and loss cannot be carried forward and set off in the future years. So this benefit or this deduction which any trust was claiming, this is also tweaked and removed now. I'll wait for a couple of seconds if there are any questions. So I'll proceed. So what is the news or what are the headlines which made which hit the newspaper about charitable trust? One of the which I found is that Income Tax Department is chasing the charitable trust for donations. A news article came on 18th April, wherein they sent 8,000 notices to taxpayers who have made large donations, doubting that these are whether they are genuine donations or whether they have received any kickbacks. To analyze that, as I mentioned, we have to be very careful while advising to our clients while doing our own donations that we make donations through banking channels. We received the Form 10B for claiming the exemption under Section 80G. Another interesting article which I found that PM Cares, whether it's a charitable trust, whether exemption has to be given. Interestingly, it was I discovered from an FAQ that this PM Cares fund is registered under 1023C, and that entity is also claiming an exemption under the Income Tax Act for the excess of income over its expenditure. There's one question: can the losses be set off against the surplus carry forward from past years? No. So the surplus which is carried forward the past years, you have only two means. Either you apply it towards the objects of the trust, or you get it taxed. You have only two options. You cannot set off the losses of this year with that surplus which is bought forward from the earlier year. No, we cannot do that with them. Yes. With that, there's one more question. In case of school, if old building is demolished due to BMC notice and new trustees are not interested to continue, then what are the consequences? So in such cases, Hemantji, the answer is that the trust has to go for dissolution and pay tax under 115 TD and close. In case the trust wants to furtherance, they may take donations from the new donors or new trustees and then continue the trust. So I think it's a practical call which has to be taken by the trust, not guided by the income tax provisions, I would say. So yeah, so let's proceed to the next segment, which is maintenance of books of accounts. Again, an area which will interest all our chartered accountants so that we can explore this area for the charitable trust. Earlier, as Section 44AB or 44A specifies certain set of books which have to be maintained by companies, corporations, carrying on business and profession. There was no specific set of books which were required to be kept by a trust. Income Tax Act realized that this is a nuance when the assessments are being carried out, they are not able to properly assess the income. So now under Section 12A, certain prescribed books of accounts have to be kept by a trust, which includes the cash book, journals, copies of bills, original bills, any other books. The interesting part is that books of accounts are now to be kept for a period of 10 years. Usually the Income Tax Act prescribes the maintenance of accounts or books for 8 years. The logic is that the reassessment proceedings are now extended to 10 years. So with that, you have to maintain your books of accounts for the 10 years. Such books have to be maintained in the electronic or written form in the registered office of the trust. Further, certain additional details are have to be mentioned. What are the incomes which are coming to the trust, where it has made the application, details of loans, properties held by the trust. It is now become a similar audit activity or a financial maintenance activity like a normal company or normal institution, how we maintain all the records. Income Tax Act has now specified this under the law for maintenance of books of accounts for the trust, which is a worth area exploring for all our chartered accountants in practice. We can explore this area. Now, just giving a quick overview of what we discussed in the earlier slides. is that whenever we look at any trust, we have to see whether it has this registration under Section 12AB under the Income Tax Act. Check whether it is performing all the activities and the activities are falling under any of the buckets under Section 215. Check whether the receipts from the trade, commerce, or business activities are less than 20% of the total receipts. Check the transactions with the trustees and all the management people, so to ensure that such transactions are only at arm's length, if any. Check that the expenses which are incurred by the trust are only within the territory of India. And in case the excess of income or expenditure is not satisfied, you can apply that income in the subsequent years by filing Form 9A and 10, and check that whether the audit in Form 10BB and return filing is done within the specified timeline. Is anyone wanting to speak? No, I assume no. Considering this, whenever we look at any trust, we have to basically check all these things to get a better idea and analysis of the respective trust. So what are the opportunities for chartered accountants in practice or chartered accountants in industry whenever they look at charitable trust? Is that we can speak to our founders, we can speak to our management, and help them formulate and educate them about the benefits which are available under Section 11 if they are intending to do any charitable activity. Help them in understanding the concepts of this exemption, and help them in the entire registration process under a trust. What are the benefits you will get out of registration? As chartered accountants, we can help them to get that registration by coordinating with the income tax department. Other avenues where we can explore for charitable trust is general advisory and this day-to-day accounting, since the Act as itself prescribes various sets of books of accounts, audits. This is an area to explore, and a lot of opportunities are there in general advisory and accounting for charitable trusts. Regular for tax practitioners is Form 10B, 10BB, income tax returns, TDS returns, applying for lower withholding tax. In my personal experience, what happens is certain receipts of the trust are subject to tax, and TDS is being deducted by the department, which has to be claimed as a refund in the tax return, and there's a huge time gap between the TDS and the actual receipt of refunds. So some of the trusts approach us saying, can we apply for lower withholding with the department? And the answer is yes, we do apply for lower withholding. So that is an area which we all can explore, speak to our clients. And the whole lot of nuances which is happening in foreign contribution, this is a totally separate discussion which is required, wherein foreign contributions are being targeted by the ED and income tax departments and scrutinized on a heavy basis to find out any malpractices or any black money being circulated through foreign sources. So these are all the areas we chartered accountants can explore, who are in practice, who are in industry, who are working, etc. Then I would discuss the recent budget amendments in 22 and 23, just so that it remains on top of our minds. Anyone has any questions or any points? I can hold for a second. Yes, I'll proceed. So the budget 22 gave some key amendments like the accumulation which we do under Section 11(2) for a period of 5 years. The earlier provision had mentioned that this amount will be taxable only in the 6th year if you don't utilize. Budget 22 has tweaked this amendment and tweaked this provision and said that this amount will be taxable in the year 5 itself if you don't spend it within 5 years. Then new Section 115 BBI has been introduced, which says that if there is any specific violation, that this investment is not made in the prescribed mode, there is a transaction with the trustee. In such cases, such incomes will be taxed at a flat rate of 30%. This is a special rate of tax which is given under Section 115 BBI. Earlier, what used to happen is all the trust used to account on accrual basis and account for all these expenses or provision for audit fees, provision for maintenance, provision karke. All these expenses were parked in provision without actual payment. So the department realized that these trusts are fooling around without actual payment and just putting expenses to show application towards objects of the trust. To tweak this, the department has introduced a provision that only expenses which are actually paid from the trust will be counted as application. If it is provided and paid in the next year, we will get an application in the next year. So payment basis we have to see. Earlier, there was no specific provision which was prescribing penalties if there is any violation under the Act for Charitable Trusts. Budget 22 has introduced Section 271 AE, which prescribes the penalty of 100% for first and 200% for subsequent violations. And certain powers additionally are granted under 12AB4 to the CIT to check in case there is any violation at the time of application itself, whether there was a violation in any form, information given in any forms, wrong disclosures made, and in such case, they have the power to revoke the registration which is given to the trust. So these were the key highlights of the Budget 22. Similarly, in Budget 23, certain amendments were brought in. This we discussed that any amount which is spent through a loan will be counted as application only in the year when the loan is repaid and not when the expenses are incurred. We have one more question, so I'll take that question. Is there any specific format for trust accounting from where we can get formats? Please suggest. So currently, I would say that there is a specific rule which I mentioned in slide, Rule 17, A or CC, which prescribes the methods of books which has to be kept. They have not prescribed any accounting Ind AS or something which has to be followed. So that accounting we can do, which we are doing for the regular institutions. Yeah, coming back to the budget amendments 23, so expenses which are made out of a loan, which will be only allowed in the payment in the year of payment of the loan. Similarly, this is an interesting thing which they have brought out is, let's say, expenses which are made out of the corpus donations or the capital donations of the trust, as we discussed in the earlier slides, will not be allowed as an expense. But in case if you temporarily use the corpus and refurbish that corpus, for example, I have a corpus fund of 5 lakhs for construction of a building. For whatever reason, I use that 2 lakh rupees for an urgent expense of the trust. I will not get as an application. But in subsequent year, if I refill that amount of the corpus with 2 lakhs, in that year, I will get the deduction for 2 lakhs. So this amendment has brought in the budget 23. Next, if you make any payment to another trust in the same year, you will get only 85% as an application and not the 100%, which we already discussed. And 115 TD has also introduced a new provision that tax on accreted income shall be payable if the trust or institution fails to make application for registration as per the prescribed methods. Means if the trust after 5 years, as I mentioned earlier, we should send calendar invites to everyone for the 5 years. If you fail to get that registration within that prescribed time, the net assets of the trust will be taxed at 30%. So we should be very careful when we deal with that. As I earlier discussed, that the new trusts were facing the issue of provisional registration as well as a new registration if their activities have commenced. So to clarify that, the amendment has been brought in that trusts which have started their activities have to only apply for a normal registration and not a provisional registration. And the last amendment which I would like to discuss is that accumulations, the Form 9 and Form 10 had to be, the reports have to be filed 2 months prior to the return of income. It's a very peculiar 2 months which has been given. So the date has expired for assessment at 23-24, which ideally expired on 31st August. So 2 months prior, you have to register, you have to file the Form 9A and Form 10 for accumulations. And in case if you don't file your income tax return on time, the benefit under Section 11 will not be available. Earlier, this condition was not specifically mentioned, but now these are forming part of Section of the Income Tax Act, so that in case of any violation, the benefit given to trust will be revoked. So with that, I will take some time to discuss the recent rulings or the recent judicial discussions. If anyone has any queries in the earlier slides, you may put it in the chat box or unmute to even discuss any experiences on trust taxation which we have not covered in the earlier slides. I'll pause for 30 seconds. I would encourage everyone to speak because since this is a study circle and not a session where the speaker only keeps speaking, I would encourage that everyone also, if anyone has a slightest experience or an issue which they faced and they discussed and they found a solution which we all can benefit, please welcome to discuss. I think we should have the face-to-face sessions where participants are more open to speak further sessions. So with that, I move to the important judicial precedents which are floating, which everyone of us should be aware in case of taxation of charitable trust. The important ruling which came in 2022, this ruling of Ahmedabad Urban Development Society was a ruling of Supreme Court. This discussed the GPU category, General Public Utility category. The other than the 6 buckets, the others category, this ruling extensively discussed on how the department should look at these provisions and how the department should tax these kind of entities. The facts of this case was this Ahmedabad Urban Development Authority was engaged in town planning activities. Their main activities were to undertake preparation and execution of town planning schemes. They claimed exemption under 11 because they don't fall under any other specific category, so they were under the general purpose category. However, the department assessing officer alleged that the activities of the SSC was not charitable purpose in light of the proviso to 215. The proviso says that if your receipts are more than 20% of your total receipts are from business, then you are not eligible to claim Section 11 benefit. So the department alleged that to this particular entity. However, this entity fought that the other 20% has to not to be interpreted for business, but it has to be seen whether it has to be applied to the objects of the trust or whether it is coming out of a pure business. So that interpretation is given here. The question before the Supreme Court was whether the activities of SSCs like authorities, such authorities could be said to be in nature of trade, commerce, or business, and hence it could be regarded as activities for charitable purpose. So the important point is the Supreme Court held that such organizations can carry on trade, commerce, or business, provided the services in relation thereto is connected with the objects for which the entity is created. First of all, the trade, commerce, or business, if any trust or institution having registration is doing, that trade, commerce, or business has to be connected. If I may give an example, let's say we have constituted marriage halls. Let's say the entity has constituted marriage halls for the benefit of weaker section of the society. If that entity also gives catering services, they give catering services subsidized cost. So let's say they receive amount of consideration from the parties who are coming there and getting their marriage done. That is connected to the main object of undertaking marriages for the marginalized sector, and hence it is connected. So we have to always see whether there is a connection between the business activity and the activity for which the trust is itself constituted. I may also give an example for a hospital. If a hospital runs an ambulance service, yes, that is a connected activity, because a hospital though may charge for the ambulance service, but it is a business in connection to achieve its main objects of medical relief. So we have to see whether there is any connection between the objects and the business being carried out by the entity. That's what the Supreme Court laid the first thing. And the Supreme Court secondly said, we have to also check whether it does not exceed that 20% criteria. Because in the earlier cases, the high courts had given favorable rulings only based on the principle that if there is no profit intention, it should be allowed to be done. But the Supreme Court has gone one step further and mentioned, first, there should be connection between the business and the achievements of objects. And second, this limit which has been given also has to be checked of 20%. And Supreme Court also commented that when the business activities are being carried out, it has to be seen whether the charges are at cost to cost, a nominal markup, or an exorbitant markup is charged from the customers. So let's say in my example of marriage halls, if the catering services are given, let's say at cost to cost, 100 rupees per plate, 200 rupees per plate, or let's say at a marginally profit, 250 rupees per plate with some margin of 5 to 10%, that it should be not considered as a business activity. But in case plates of rupees 800 rupees per plate, 1000 rupees per plate with a normal markup and an exorbitant markup business activities are done, such cases this 20% has to be applied and checked whether the receipt from business 20% is more than the total receipt. If that is more than the total receipt of 20%, then you will not be eligible for the exemption. And then the Supreme Court specifically instructed the tax authorities to scrutinize the records of such kind of trusts where they have doubts to understand whether they are into business or not. And based on these principles, evaluate whether the 11 benefit should be eligible or not eligible. So actually, this is a 150-page ruling. So in the interest of time, I have just covered the main principles which are enumerating from this ruling. Let's just take a question on the chat. Is your PPT available for? Yes, sure. I will circulate this PPT subsequently after our discussion, so that we all benefit from this. Next ruling is again a Supreme Court ruling which came recently in 2022, Ranka Charitable Trust. Here the issue was when a trust goes to the officer for ATG renewal, can the officer sit and examine whether the activities of the trust or the income of the trust was used for charitable purpose or not used for charitable purpose? So when this issue, when this trust had applied for registration again under ATG, a re-registration, the assessing officer rejected the application, stating that the income of the trust was not used for charitable purpose. So the SEC's argument was that Section 80G only says that the instrument of the trust should not have any clause where the income is not applied towards a charitable purpose. So the registration documents has to be checked at the time of registration, not whether the trust has applied the income towards the charitable purpose or not at the time of registration. So with this argument, the Supreme Court held that this activity has to be checked at the time of assessment and not at the time of registration. And hence, the Karnataka High Court ruled in favor of the SEC and the Supreme Court confirmed the Karnataka High Court ruling. So there's a question that is there any specific provision for religious trust or all trust provisions are applicable to religious trust? Yes, there are some tweakings for a religious trust because anonymous donations for a religious trust are not considered taxable because, for example, if in a trust, in a temple or in a church, in a masjid, there may be hundis kept for general people donations. People may donate 500,000, 1 lakh, 2 lakh, however. So you don't know the identity of the person, and that donation cannot be taxed at the rate of 30%. So considering that there are certain tweakings for religious institutions which the Income Tax Act has realized, considering the diversity of India. There are certain other reliefs which are given to a specific religious institution, but majorly they fall under Section 11 or they are given some specific registration under Section 1023C. If I go to the next case law, Karnataka High Court ruling in case of Embassy Charitable Trust. In this, the issue was that at the time of registration, when the Income Tax Authority saw the objects of the trust, they found out that one of the objects was construction maintenance of housing, which is commercial in nature. So considering that, they rejected the application for registration. So the High Court observed that when a trust comes for registration, you have to first see what is the primary object of the trust. In this case, the primary object of the trust was charitable in nature. It wanted to provide certain benefits to certain old age people. You have to see the primary object of the trust. If the primary object is charitable, then you have to give benefit to the trust and you have to give registration to the trust. If one of the objectives is erection and construction, you have to read that object again with the main object. Maybe it is for the welfare of such people. Maybe it is for constructing a house for such people. So you have to read, you cannot take one object in isolation and say that this trust is not a charitable trust. Based on that, the Karnataka High Court has ruled in favor of the SSE. I've highlighted few other case laws to understand how the department and how the tax authorities are thinking. First ruling is in case of Delhi High Court, wherein this entity was running a printing press and publishing a newspaper, whether such entities are charitable entities. So the Delhi High Court held that profit generated by such entities is used for charitable purposes and there is no profit motive in running such business. And hence, this trust is for charity and benefits under Section 11 is eligible. Next ruling is of Chandigarh ITAT in case of Kurukshetra development, wherein this trust was engaged in activity of maintaining and preserving historical places in and around 48 kilometers of Kurukshetra, which is a holy place. So whether such trust is also eligible for benefit under Section 11, the ITAT held that income from tourists for carrying out activities like sound and light shows, since there was no commercial element involved, nor such activities were motivated by profit motive, the SSE's case did not fall within the proviso to 215, and this came within the maintenance of historical monuments and historical places, and hence the 20% limit will not apply here, and the SSE is eligible to claim benefit under Section 11. Next ruling is in case of Karnataka High Court, wherein a college was running educational institution and the assessing officer denied exemption under Section 11, stating that they are collected capitation fees at the time of admission. However, the Karnataka High Court held that since the state government itself has not lodged any complaint or found the assessee guilty, merely because of collection of capitation fee, the trust cannot be denied the benefit of Section 11. And the trust was given the benefit of Section 11 in this case. Next case is of Agastya Foundation, Bangalore ITAT, wherein certain foreign travel expenses was incurred by the trust. As I mentioned in the earlier slides, the expense has to be incurred within India. However, in this case, foreign travel expenses were incurred, but such expenses were incurred to collect foreign contributions. So with this specific justification, the Bangalore ITAT held that since this expense was incurred to get foreign donations, such expense should be allowed and it's for the charitable purpose. There's a question in the chat box for accumulation up to 5 years applicable from which year? I think it's applicable from AY 21-22. I can recheck the specific year. Pushpa, you can reach out to me separately. I'll just ping you that specific year because I'm just getting confused between 21-22 or 22-23. Yeah. The next ruling is of Delhi ITAT in Manohar Education, wherein a similar institution was running education institutions, and the trust had purchased a luxury car. So it's unusual for an education institution to purchase a luxury car. The trust had replaced the old Audi car with a new Audi car. So if from a normal perspective, when we see such kind of expenses, we think that these are not expenses which a trust has to incur, but the department held that it was an expense incurred for the trustees and the vehicle of the trust, which was used for the purposes of the trust, has been replaced. Such as expenses should be allowed as applied towards objects of the trust. So this was an interesting ruling which I found. The last ruling and the last point of discussion for the day is our favorite beloved Board of Cricket Control of India, which is under strict scrutiny of the income tax departments. Certain tribunals have held that this is not a charitable organization. Certain cases have held that this is a charitable organization. The object of BCCI is furtherance of cricket in India. So they say, even if I do IPL, even if I do all these commercial activities in a jazzy manner, my end objective is not to earn a profit. My end objective is furtherance of cricket in India. And hence, even if I do it in a very lucrative manner, my end intention is furtherance of cricket, so benefit should be allowed. Mumbai ITAT in 2021 has held that continuance of registration on a 12A should be allowed to BCCI. But across India, if you see various registrations given to these cricket associations, contrary rulings across everywhere. Some say that they should be allowed registration. Some say they should not be allowed. Some discussion of this is also there in the Supreme Court decision of urban development. But again, it has been given with certain guidelines to check whether the end usage of the funds are for furtherance of cricket, or whether there is no end usage of funds, or whether these funds are just lying with these cricket authorities. Since this is in limelight, I thought we should discuss this. So with that, I open the forum for questions or any thoughts or discussions. And yes, Jyoti and others.
Thank you, Srinath. I think the concept was very nicely explained with discussion on case laws and rulings. That was wonderful. Just will take questions. If anyone has any questions, you can just unmute and ask.
Yeah.
If there are no questions, we can.
Yeah, there is a question, ma'am. Sorry, may I ask a question?
Yeah,
Yes,
sure.
yes. Sure.
Okay, in ITR 7, there is this whole calculation that has to be done of income earned from the property of the trust with the various buckets that you explained.
Correct.
Then you have the expenses for application as you explained.
Correct.
Then there is a very funny situation, because basically what happens is that they say this is the income earned from the property of the trust. These are the sources of your income where you have taken the money to have your expenditure.
Correct.
Now, there is always a mismatch. Always there is a mismatch wherein the what do you call it? The actual income that you earn will be 1 crore. Now, if you have used accumulation from the previous year, or if you have used that 15%, which is that deemed application income, see, there is always an issue. There is no issue when you say, okay, this is my source of income. I have received it from here. I have applied it to these purposes. Then there is another one where I have applied it, but I am disallowing it because they come under the disallowances. I'm not allowed to apply it here. Then there is a mismatch when it comes to the fourth part. Is there any solution to that mismatch? Because it's like doing tic-tac-toe sometimes.
Yeah, I totally understand this. We have also faced such circumstances. Initially, when I was earlier doing this, I used to get lost in the computation that some amount of income is getting applied from the earlier year, some expenses are getting applied out of corpus. So all this sort of confusion is to come. To make it simple, I would suggest that the way we draft our computation, it will help us to fill the ITR. The computation, we have to be very clear on how we bifurcate the corpus income and the expenses which are made out of corpus, that also on a yearly basis. From the year when the corpus has been received and what expenses are made out of corpus, that is bucket number 1, we bucket it. Bucket number 2 is the 11-2 accumulations, that is which we have made for a period of 5 years. We keep it totally separate on the expenses which are made from that. And third is the expenses which we make from the regular donations which comes from this year, and we do that expense from this year. So what happens is, I agree there is an overlap between this 11-2 expense and what we do in the current year. what my experience has been is the way we keep our computation robust on Excel or on some software which we use. That will help us fill the ITR because there is no other way or solution. We have to give the information to department as the way they want.
Thank you, sir.
There's one more question on the chat box. Yeah, PPT I would definitely share after this call.
Thank you. Thank you so much, Srinath. I think the topic was very well covered, or each and everything was covered in a well, understandable manner. Thank you so much for giving your valuable time. I hope all the participants have received a good knowledge after this session on charitable trust. Thank you once again.
Thanks, Jyoti. Thanks, Jyoti, for this
Yeah.
opportunity. Thank you.
Okay, thank you. We'll close the session now.